On behalf of SABU and the National Endowment for Financial Education, it's my privilege to introduce this discussion. I think many people who are here at this conference probably are aware of who NEFE is, but for those who aren't, we are a completely independent nonprofit foundation that is wholly dedicated to effective financial education. A lot of our work is in support of journalists who are doing personal and consumer finance reporting, and we've been a longtime partner. Caleb, during the sponsorship section, said that we were a longtime partner. This is our 15th year, in fact. So this group has been very important to us. We've had a great relationship, and what I find really important and wonderful is that over the years, we've become more of a content partner, so we can help produce sessions and discussions like this rather than just being a sponsor. I'd be remiss if I didn't mention one of our core activities, which is College Connect. That is a student blogging program that we do through partners at the University of Missouri and the University of Georgia. And these are emerging business journalism students who are writing about personal finance from the lens of younger adults. There's a lot of wonderful content and a lot of great ideas and concerns that people are writing about. So I invite you to go to the SABU website to check it out. And if you can help bring visibility to these blogs anyway, through your outlet or through your institution, we would love and welcome any of those ideas. So please reach out to SABU staff or myself, and we'd love to talk about that a little bit more. This year, NEFE is celebrating its 30th anniversary. And what we have always strived to do in our work is provide for the financial education field what's not being met. So for a long time, that was curriculum development through K through 12 college adult learning programs. Now that is being done by other organizations, and we're not going to be duplicative in those efforts. So it's like, what else does the field need right now? And right now it's data, a lot of data. And so we have a commitment to bringing more data. And that data is interesting because it can support the work that you do. It adds context to your stories and your reporting. Early on in the pandemic, we started to do a whole series. It spanned more than 20 months now, looking at the financial well-being of U.S. adults across the country, and it's had several milestones along the way. And consistently through that polling, I'll say that what we wanted to find out through this information is where concern and worry and anxiety is coming from. How are people adapting their finances because of the pandemic? How are people providing support to friends and family, and what is the impacts of them providing that support? What we found pretty consistently through our data is that 85% of people say that they have stress about something related to their money. That's 85%. That's most people in this room. It's a probability that you have friends, family, colleagues who are having some anxiety about money, something related to money. And for 21% of those people, it's housing related. It's rental affordability, it's the ability to keep up with mortgage payments, it's rising interest rates. So this is an important topic, and this is why we wanted to bring this to the conference today. Check out our polling on NEFE.org, not to do a shameless plug, but we are an independent foundation, and we want to make sure this information is out there. It's there for your use. And with that, I think I'm going to turn it over to Stacy and get going. We're sorry a little bit late, so we'll take your questions at the end, and we'll go from there.
Well, thank you everybody for joining us to talk about housing. And I might just have you guys all introduce yourselves with just like a little sentence about what you do and why you're here. I know we're all up on the screen, but sometimes it's nice to also just get a little introduction. Lawrence, would you like to begin?
Lawrence Yun, Chief Economist with National Association of Realtors. We currently have over 1.5 million realtors, essentially at every corner, every community across the country.
And Daryl?
I'm Daryl Fairweather. I'm the Chief Economist at Redfin, which is a tech-powered real estate brokerage. You may know our website or our app. I've been there for 4 years, and I study the housing market.
Dolly Lenz with Dolly Lenz Real Estate. I am a luxury real estate broker, but also an often talking head.
Daryl, I'd love to start with you. Obviously, the housing market has been through quite a wild ride through COVID, but paint us a picture, if you will, of what the housing market looked like right before COVID, because you guys are getting data from all over the country all the time.
Yes, back in 2019, a very long time ago, the housing market was just coming out of a bit of a slump. In 2018, mortgage rates were rising, kind of like how they are now, and that slowed down the housing market quite a bit. But 2019 mortgage rates were coming down and the housing market was taking off again. We were expecting a very strong year for both sales and price growth. But then COVID happened and it put everything into a freeze. And I don't know if you want me to say what happens next. Okay. As you probably know, the housing market just took right off. There were a couple of weeks in March where everything was kind of at a standstill. But then as soon as mortgage rates came down, people just came right back to the market. People didn't have much to spend money on besides housing. So people were really eager to get more space, to get out of the city. And that just put the housing market into super drive. And then remote work also accelerated things as well.
And Dolly, I feel like you're kind of our boots on the ground in the real estate market. What did you see? Obviously, you're in New York, which is sort of a special case, but what did you notice during the pandemic? How did your business change?
So we're in New York, but we're also outside New York because we follow the client. So wherever the client wants to go, we fly there, do intel for them, and then come back, report, and they come and purchase a home wherever that may be across the country. New York-wise, it died. You know, we weren't allowed to show property. We weren't allowed to do anything for many, many, many months.
Because of COVID restrictions?
Correct,
Or?
correct. So literally died. You know, you couldn't do anything, and, you know, we had a lot of hysterical sellers, but there was just nothing we could do. From there, you know, then places like, and everything shifted, we found. So yes, there's great demand, but the demand totally shifted out of cities, right, not just New York, right, into outer areas. And that could be Brooklyn, right? Or that could be Westchester, or that could be Greenwich. Wherever it is, it was outside an actual city. And that is what made, I think, the housing market boom. Because those areas were distressed in 2019, just prior. And all of a sudden, you couldn't keep a house on the market more than 3 hours. It was crazy and continues till now. Although perhaps the interest rate environment may change that a bit.
Right, and I believe overall, nationally, housing prices are up, is it 10, 15%?
It's around 14%. It depends on who's measuring it, but yeah, that's about right.
And Lawrence, kind of looking ahead right now, obviously it seems like interest rates are on their way up. What do you expect to see? Is this like hot market going to continue? Do you expect to see things slowing down?
It will definitely moderate. The housing sector is one of the more interest rate sensitive sectors. So when the Fed is raising interest rate for, say, trying to contain inflation, naturally it's trying to focus on the interest rate sensitive sector, and housing market always respond to that. So when rates rise, inevitably, maybe not in the first couple of months, because first couple of months there are people who are dedicated to buying. Maybe they lost out on the multiple bid. Their still mindset is to buy a home, so they're still in the market. But rising interest rate just shrinks the pool of eligible buyers. People who could barely qualify at 3% mortgage rate, they simply don't qualify at 5%. And my projection is that this year we're going to see home sales down about 10% compared to last year, which means that it's actually coming back to pre-COVID activity. Now, home prices is a little different. Home prices over the past 2 years, probably around 30-35% rise in most communities. I mean, substantial growth. And there's a lot of question. Is it a bubble? Will it come down? Very valid question after what happened 15 years ago. But the fundamentals are different in terms of the mortgage products is safe, not the subprime lending condition. And the construction, construction activity was too much 15 years ago. This time around, just simply not enough inventory because the builders have been underproducing for a decade, and the cumulative effect of that is we simply don't have enough inventory. But the price growth, we will not see the double digits anymore. Certainly, with each passing month, price growth will moderate, but I don't think it will decline on a nationwide basis. Some market like Phoenix, talking about price growth, over 30% growth in a single year. If it corrects 5%, is it a crash, or is it, the data has been so volatile, so no one really knows what's going to happen. But plus or minus 5%, I think that's just a measuring error, considering how fast it has risen.
And Daryl, I think you mentioned this, but it's been kind of a unique situation in the housing market too, because the way we work changed and our ability to work from wherever, which has kind of moved the market around a lot and has pushed up prices a lot in areas that I think weren't traditionally super expensive or don't necessarily have like the local economy to support those housing prices. What have you seen in kind of local communities? I mean, we've heard stories, I'm thinking of like Bozeman, Montana, and some places where this has been really kind of highlighted.
Yes, it used to be that these record-setting price growths were only happening in California markets or coastal markets, but now it's spreading everywhere. And I attribute that mostly to remote work, because remote work opened up for a lot of people new areas to live, including myself. I was living in Seattle before the pandemic, but then Redfin went remote and I moved to a vacation town in Wisconsin. And many people made a similar choice, moving somewhere that fit more with their lifestyle, maybe moving somewhere more beautiful or moving to be close to family. People just completely reevaluated the way that they live. A lot of people wanted more space, that they had space to work from home. Some people dropped out of the labor force, like a lot of women with children dropped out and wanted to live somewhere with like better school system or more support from their family. So we saw a lot of people move. We actually did a survey of why people were moving, and before the pandemic, the number one reason was for a job, but moving for a job dropped down and every other reason became more common. So people just are able to live wherever they want. They're not so tethered to their job right now. That used to just be for remote work jobs, but now with the tight labor market, more and more people are moving just for affordability reasons. We actually saw the share of Redfin users looking for homes outside their metro, that increased from 26% to about 30% from 2019 to 2021, but it's still increasing now. Like, we thought it might peak during the pandemic, but it's only going up because of these affordability concerns.
Right. I mean, you mentioned, Dolly, that a lot of your clients are now looking kind of outside of cities and in smaller areas. I know that you tend to deal, I imagine, with wealthier people, but is that kind of pushing the prices out of range for a lot of folks?
Completely out of range, out of whack, out of sanity. I mean, if you look at places, let's just use Palm Beach, Naples, Florida. So houses have sold 10 million 6 months ago, 15 million 6 months later, 20 million 4 months after that, then 25 million. So the 10 million house is now 25 million and perhaps going up from there. And it's hard to justify. There's truly, it seems, no sanity to it, right? I get it, some people just came into the market. They may not, even with Redfin and all the data, they may not actually know that house was $10 million. We find that's true. So we're telling them, hey, that house was $10 million. Are you sure? Do you want to do this at 25?
Are you saying that to clients?
Yes. But you know what? I feel that's our job, you know,
Yeah.
and I don't want them coming back to me later and saying somebody said that to me. So to us, it's like, how does this make any sense? And how is it possibly sustainable over a 5-year period?
Yeah, I mean, obviously, the thing that keeps coming up in my mind, right after I started my career as a reporter, the housing crash happened. So that is what keeps coming up in my mind. I mean, let's open it up to anyone who wants to jump in, but do you think we're headed for another situation like that, or do you think maybe property prices are going to stay elevated? I mean, Lawrence, you mentioned, like, well, even if prices come down by 5%, you know, they're still up in the double digits.
Yes, and you know what's going to happen on the prices. Certainly, I don't foresee a foreclosure crisis where you have the, you know, because of the even people who cannot pay mortgages, the mortgage forbearance program, part of the stimulus measure, that is winding down. And people who cannot find job and cannot make the mortgage payment will be forced to sell their home, but they realize they have substantial wealth gain or equity gain, and it doesn't have to be a foreclosure sale. We are seeing increasing number of cash transactions, and by definition, it cannot be a foreclosure. It's all cash transactions. But the big difference, again, the mortgage underwriting is much sounder this cycle compared to just insanity 15 years ago. And the housing construction, the cumulative effect, the shortage, and I think the shortage will keep the houses firm. The other factor is rising rent. We have a housing shortage, not only to buy, but in the rental market. So the rents are rising strongly, and rising rent is also a push for people wanting to buy a home. And certainly when the prices were to decline 5%, I think they will take that opportunity.
See, my fear is the perfect storm of the stock market adjusting, going down, whatever you want to call it, interest rates going up, and all of that together to brew to lower confidence, right? So real estate is always a confidence play. right? Besides housing, you're thinking to yourself, I'm putting this money in here because 30 years from now, I'm going to own it free and clear. It's my house, and it's my biggest investment, my most important investment. So as an investment vehicle, it does worry me. Although the American dream of a home, I think, is very too solid. But I do worry with the stock market going down and interest rates going up that the confidence starts to ebb.
I actually think that's a good thing that's happening now, though, that mortgage rates are going up, because if we had another year of double-digit price growth, like that's when I would start to worry about there being a bubble. I think that people like to compare where we are to 2005, 2006, but I think where we are is actually closer to 2001, where we're at the beginning of prices maybe getting too high, but the fact that interest rates are going up now, hopefully that gives everybody kind of a reality check. Mortgage payments are now 40% higher than they were just a year ago. So that's definitely going to have an effect on demand and make people less willing to pay these high prices. And I think, like Lauren said, it'll stabilize the market, not necessarily deflate it, but that's a good thing right now.
And like Lauren said, the qualifying, that's the hard part, right? So if you qualified last year, you probably don't qualify this year. So you can't get a mortgage, or you have to expand where you're living, right, to get the house that's a little less expensive.
Well, I mean, like you say, Dolly, often homes are more than just an investment. People have traditionally used them as part of the American dream, as part of a way to kind of level up. And it's sort of the asset that people, there's the phenomenon of the starter home. It's how people have traditionally started growing wealth. Is that going away? Is that already gone? I mean, it seems like things are getting a little more out of reach of the average person.
I mean, definitely it's getting out of reach, so we'll have to see how it plays out with all the modifications that are happening. But people are definitely getting depressed and on the sidelines as a result. We have a lot of people taking breathers. They're like, you know what, I'll call you back in September.
Yeah, just in terms of the social aspect, societal aspect of it, is that, say, a couple of years ago, two people, very similar situations, say a teacher, similar salary, one person just happened to buy a home, other person did not, but for whatever reason. Well, now one person is much wealthier, while other person is not. So, and one thing's back, like in San Francisco, when it was reasonably affordable, when the median price in San Francisco was, say, $200,000 20, 30 years ago. Again, just think of teacher who had bought versus one who did not, compare the situation today. So this 2-year housing market boom that we encounter, home ownership rate actually did not increase. Home ownership rate remained the same. And then, of course, there is a large gap between, say, white home ownership rate versus many minority families, African Americans at about 42% versus white Americans at 75%. That has a social consequences, I think, in terms of how people feel about whether they are part of, living the American dreams.
Well, and it's interesting, I think you mentioned that the supply of housing is not getting replenished. Obviously, there are supply chain issues, but also building slowed way down after the housing crash, and it didn't really get rolling for a long time. I mean, obviously, in economics, it's supply and demand, so the answer to housing getting out of reach is to increase the supply, but that gets a little complicated. I don't know, Daryl.
Yeah, it has not been a priority for this country. A lot of it has to do with just the politics of how housing gets built. It's usually local control. It's neighborhoods who are deciding how much housing gets built. And if you're already a homeowner, it's just not your problem anymore. If anything, you're kind of resistant to building more housing because you have this asset that is rare, and the more housing that gets built, the less rare it is. So I think a lot of homeowners are kind of part of the problem there. And we just also as a nation aren't really tackling this problem, I think, because it's not very politically viable for politicians, because it's something that needs to be solved over a decade span. It's not going to be an easy win to put hundreds or billions of dollars into housing. It's going to be something that, if Joe Biden did this today, he's not going to get the benefit for a decade long after he's president. So I think that's why it's not something that's being a political priority, even though it is the foundation of how we make people better off in this country. If people are putting so much of their money towards housing, they don't have money for all the other things that would make this country dynamic in terms of its economy.
And the other problem is all the homes being taken off the market by Blackstone or, whomever who
Is
is
that really a big force?
I think it is. I don't know what the numbers are. Maybe you
Well,
do, but it seems big to me.
We're seeing the share of investors buying like homes that everybody would be able to buy, like for sale homes on the market, increase. I think it was up to 18% the last time we checked at the end of the year. But I think that's, yeah, it's big, but I think it's more of a consequence than a cause. Now that home prices are going up so much, investors see that this is something that they can make money off of. And unfortunately, that makes it harder for the people who really just want a home to live in. They're not trying to like profit off of it. But when investors get involved, I get worried that they're going to be the ones who also have more of a voice politically or lobbying to keep that system going. So I think that's one reason to be concerned.
And they're making financial vehicles, right? So they are selling your share of these 1,000 homes and the rent roll. See, that's where I think it's an issue. I think an individual investor buys another house, another apartment, I don't know. But where we're talking about, it's a dynamic that's coming from big corporations. I think that could be an issue that I think could be addressed in a shorter term.
So one thing that our members are talking to members of Congress about is that with the Wall Street investors buying single-family subdivision in certain localities, essentially they're buying half, which means half are not available for just owner occupancy, is that to see whether or not for long-time real estate investors who have accumulated quite a sizable capital gains. So if they were to sell for whatever reason, the other lifestyle changes, there is a hit on the capital gains tax. And just psychologically, they don't like that. So some kind of reduction in capital gains tax for sale by a mom and pop investors to a, say, first-time home buyer. Now, of course, one has to figure out, how do you verify and all that part, but I'm sure one can figure it out. So that will provide some additional inventory at a time when the Wall Street investors are trying to gobble up that property. So we are, in essence, incentivizing some releasing property onto the market through tax policy changes.
Yes, and I think, Dolly, you and I were talking before the panel, and you mentioned that obviously New York is a big market for international investors and buyers, and you said you had noticed that ticking down a little bit.
Yeah, quite a bit, and it's because of mostly the pandemic, right? So, but it's also the laws they're putting into place about LLCs and disclosure and not making things quite as friendly as they had been, right? So a Venezuelan wanting to buy a home in Miami, didn't think about it, just bought a home, created a trust, an LLC, whatever, and bought it. But now they're forced to cover paperwork saying, well, who are you? What's going on here? And even the good cops don't want that, right? People don't want to be open to, well, what if you think I'm not a good cop, right? So it's not just taking away the buyers that were nefarious, but it's also taking away the buyers that weren't. And I think that's probably a good thing for the average buyer, because now those people are largely out of the market, but not a good thing for real estate brokers.
Right. I mean,
and sellers.
Yes. When you were mentioning that people are sort of holding back a little bit and saying, I'll wait until September, is that sellers or buyers or both? Oh.
But mostly buyers. Buyers are just feeling, okay, you know what? I tried 3 times. I didn't get the house. I didn't get the apartment. I'm done. I'm going to take my summer. I'm going to relax. I'm all stressed out anyway. I'm going to relax. And that's what we're hearing over and over and over.
Yeah, one area of sort of investigative reporting is the topic before us, which was cryptocurrency, and topic after us, which is the Russian assets, to see whether or not the Russia, with the sanctions in place, whether they are still able to come and buy U.S. real estate using some cryptocurrency anonymity. I don't know, but it'll be interesting, especially Russian being very heavy here in New York City as well as in Miami market for real estate purchases.
Do you have insights, Dolly? Do you know about this?
Yeah, I mean, I think it will be very interesting whether they're able. I mean, the only way I see they can really do it, right, is some sort of shill situation, right? I don't know without a shill how they're doing it. I mean, the DOJ is on top of this. They're following. They're a super smart group of people, and I think they'll get caught unless they do have a shill of some sort, a partner.
Is a shill like a shell?
In other words, like a fake person.
Oh, like a fake,
Yes,
like a fake
yes,
buyer.
Yeah, like Mrs. Smith now turns into someone else, and maybe Mrs. Smith is your partner, right? And that's why she is your shill. But I don't see another way, from what I do paperwork-wise, that you wouldn't catch it. Like Acris, right? When they put out Acris in New York, you see all the documents of every purchaser, and anyone looking through that is going to know. And if they don't know from that, they'll know from where did the maintenance bill go? Where does the real estate tax bill go? So it's all discoverable. So it's going to be very tough.
I think we are to the time when we can open it up to questions. If anybody has any questions, I mean, I can ask all day, but go ahead.
Hi, my name is Elena. I'm a senior data journalist from Stacker. As you mentioned, inventory is one of the biggest problems that's driving these increases, but new homes that are coming to the market are expensive. And then also, builders are incentivized to build luxury homes to kind of make a return on their investment. So how do you kind of combat that of getting affordable homes to come onto the market as opposed to expensive homes that the average person couldn't afford?
Go ahead.
I think one of the most important things is to reform zoning laws in places that people want to build so they can build more housing on the same amount of land. Also just make it easier for builders to build. There are other things you can do like mandating affordable housing in a high rise, for example. You make sure some of the units are affordable. But I don't want to demonize the new buildings that are coming on for being above the median price, because today's new building will be a decade later the affordable housing unit. And one of the reasons we have so little affordable housing now is because we weren't building a decade ago. So we need that continuous stream of new housing coming on, even if it might be a little bit more expensive than what we'd like to see.
Even for today's market, the larger expensive home often for trade-up buyers. So as they are trading up, they're releasing their old house, smaller, more affordable house onto the market. So it just increases the overall supply. But to directly address affordable housing today, I mean, it has to require some form of tax credit or government funding. Numbers simply don't work for the builders on their own.
But as someone who grew up in low-income housing, I can tell you it's truly a devastating issue. If you are there and you're trying to get out, it's a very long climb to get out. And I think that if government doesn't prioritize it, tax incentives, zoning, local government, state government, federal government, it has to be incentive. It has to be the priority of every community to house people. How do you get nurses to work, teachers to work, the person making sandwiches to work? How do you get them to work? They can't travel that far. So it's to all our benefit to do that. And I think, I know it's being done on local levels through activist groups, but I think it needs to be expanded from activists to actual people who are taking this charge and saying, yes, this is a priority.
Hi, I'm Annalyn Kurtz. I teach business journalism at NYU. I was hoping you could talk about the home buying trends you're seeing across generations. I'm asking this question as an elder millennial who graduated into the 2008 crisis, and I'm seeing a lot of friends, are in their mid to late 30s. The timing of this current real estate market is so difficult for them. They thought they'd finally gotten some sort of financial security, maybe could start thinking about buying a home, and now it's just out of reach yet again. And then I'm here with a lot of my students who are Gen Z, and they're probably listening to you thinking, am I ever going to be able to afford a home? So I'm just curious, what are the trends you're seeing across the different generations?
The age for first-time buyers is getting later and later in life. But whether this is, certainly affordability challenges a factor, student debt, which is fairly new, recent phenomena over the past, 2 decades that was not present before. The other part is, I'm losing my train. So the student debt, the affordability issue. This morning I spoke to people out in West Pennsylvania, the realtor group, just talking about the market trend. The median price there is $120,000 or $130,000. Anyone with a job would be able to buy a decent-sized house there. Now, of course, for a New Yorker, is that attractive to move to West Pennsylvania? Now, remote work does provide some flexibility of a wider geographic search area, but incredibly, there are still many towns and communities across the country. It is very affordable. But regarding wanting to live in a superstar city is always more difficult. But Even, say, Connecticut, even Hartford, not the Greenwich, but a little further out in Hartford, the market is booming because many people who are working in Manhattan understand they don't have to commute every single day. So we are seeing Connecticut, which was one of the softest, weakest housing market pre-pandemic, booming post-pandemic.
And there's also size, and there's also size, right? So it doesn't have to be a house. It could be an efficiency apartment. You know, you can get on the rung, get in somewhere on the rung. Don't necessarily go for a house, which involves maintenance, work, all kinds of issues you don't know until you go in. Get an efficiency home, you know, a studio apartment, whatever. Jump on the ladder, then you'll sell that and get into the next level. That's what I recommend to young people who are coming to us.
Another generational trend that we've noticed is people are staying in their homes longer. So especially for baby boomers today, they don't want to move into elder care, especially with the pandemic. That's become even more of a thing that they don't want to do. So they keep their 3-bedroom home with the yard and the good school district, and it's not opened up for the next generation of buyers who wants to use that home, who may use it to its fullest purpose a bit better. And my grandparents and my parents are guilty of this too. Part of it has to do with the tax incentives. I'm from California, and the way taxes work there is that you're pretty much locked into the tax rate of when you bought the home, which means that, you know, 2 homes that are on the same block, exactly identical, one might have a $2,000 tax bill and one might have a $20,000 tax bill depending on when the home was bought. So unfortunately, the people who own the homes have a lot of political power and are able to kind of lobby for those kinds of tax changes. So I think young people should get really vocal and involved in their local housing authorities and kind of advocate for changes and advocate for more housing so that they have a chance to get into the housing market.
I have a question, Ray. Oh, you could go.
Sorry. Hi, I'm Beth Trefaison. I'm at the NYU graduate program and also working at Crane's New York Business. I had a question for you specifically to the New York market because that's what I've been covering. I was wondering if you noticed with the higher interest rates, if that's keeping people out of buying their first home or their first apartment and keeping them in the rental market, and if that is making the prices in the rental market continue to rise. Because I think just this month we saw rents continue to skyrocket here in New York City.
Well, I think that's one very good reason, right? So people are renting and therefore the demand is way up. The other reason is people leaving. There were still people leaving parents' homes in Connecticut, Westchester, New Jersey, wherever, coming back to the city because now they have to come in 3 days a week. And that's really causing the boom we find in rentals. We took a client out yesterday, and an apartment that would have rented, very small 2-bedroom, not a great location, that would have rented for $5,000 9 months ago is $7,900, and they have 3 applications. So how do you go from $5,000 to $7,900? I mean, a month. And again, not a great location, kind of a starter apartment, 800-foot 2-bedroom. So yeah, I think your reasoning is the best, but it is additional demand from people coming back to the city because of the free pizza and donuts.
I was saying that at NPR, they're trying to get us, they're going to kill me. They're trying to get us to come back to the office by sending out emails about free food. They're like, free pizza, it's like the carbohydrate offensive.
Yeah.
It seems to be working.
Yes.
It seems to be working.
But you're paying them rent, so it's okay.
Yeah.
Yes, Rudy here, editor at Impact Alpha. You guys have done a very good job talking about the economic and market fundamentals in regards to affordable housing. But I'm a little disappointed because the headline talks is about the crisis, the nationwide crisis. And I think Dr. Yoon, you're the only person who mentioned kind of what minorities and African Americans, Latinx, and other underserved groups are going through in this affordable housing crisis that we face here in the U.S. And so, I'd love for you guys to talk about that a little more. And also, I'd love for you guys to talk about the importance of the local lens of investing in affordable housing, working with people in affordable housing, as well as home ownership.
Because of the rising housing costs, again, it requires the numbers simply don't work for the builders to build affordable housing. So it does require either government funding or some kind of tax credit. But large employers are also getting into the game. For example, Amazon, their second headquarters is in Arlington, Virginia. I mean, they're dedicating large dollars for affordable housing, and we see other large companies who are able to do that, whether in terms of helping on down payment assistance or maybe even a zero interest loan for a certain period where people can use that zero interest loan as part of their down payment to make it access in terms of becoming a first-time buyer. So we see more private companies because they want their employees maybe come back to work, live close to us. But also they understand that housing has become a crisis, especially in I call it the superstar cities, very expensive cities, but people still want to live in these areas. You see the price of onions rise in India, and there's a street protest. Price of bread rise in Egypt, there's a street protest. Price of gasoline rise in France, the yellow vest movement coming out. So what could be that really potentially trigger in America? I think the housing where people feel completely frustrated, they cannot pay their rent, and certainly trying to buy a home becomes impossible. So if people feel left out, I wonder whether or not this could lead to some serious social consequences.
And to talk more about this issue, you have to kind of put it in historical context why the African American homeownership rate is so much lower than the white homeownership rate. Redfin did a survey of homeowners, and we found that one of the top predictors of whether or not you're a homeowner is whether your parents were a homeowner. And you think back a generation, how difficult it was to become a homeowner as an African American, and then go back 2 generations, it was even harder. It's not an even playing field. If you don't have that intergenerational wealth, it's very difficult to break in. And then on top of that, the goalpost keeps moving for what you need to be able to pay for a home. So it just becomes even more difficult. So anybody who says that these racial discrimination problems are a thing of the past, it's just completely false. It keeps carrying through generation after generation. And we have to do more to make the playing field more equal, or else it's just going to naturally get more unequal.
Makes perfect sense. And it's terrible because it then takes the next generation, again, is going to be hurt. And they're hurt in every way, right? They're not only hurt in their home, they're hurt in the school district. They're hurt in every way. So it is something that needs to be addressed. And again, what we said earlier about there are activist groups looking at this, holding low-income landlords accountable, which is another issue, right? Because low-income landlords, a lot of them, what they're doing is having construction in their buildings so they can throw people out 24 hours a day, right? So they can make it not low-income housing, right? Or all kinds of things like this. And the activist groups, I think, are doing a really good job, but it needs to be bigger. It needs to be all of us, and it needs to be the government for sure.
And I think you mentioned too that just looking at it through the lens of building more is not really showing the full picture. When Biden proposed his housing plan, he put a really big emphasis on reparations through housing, which I think is an interesting way to go about it, really undoing some of the damage of redlining and focusing on it from a housing lens. I think that could be an interesting way to make the playing field more equal, to just acknowledge that there were these inequities and we are obligated to do something about it.
James Medora, I write about the economy for Newsday. I was wondering if you could talk a little bit about what we're seeing in terms of multifamily housing, townhouses, condos. Where I live on Long Island, a lot of people have given up on having a single-family home. And so now they're saying, I'm going to live in an apartment the rest of my life, or a townhouse, or a condo. What are we seeing nationwide in terms of that type of housing?
During the pandemic, condos and townhomes fell out of fashion because everyone was looking for more space, but now those single-family homes in the suburbs have gone up so much in price that people are now looking more towards condos and more towards townhomes. And also with the return to cities, I think that's accelerating that trend as well. I think we should change the view of what is the ideal home from the single family home with the picket fence to the townhome to the condo, because if we want to be able to accommodate everybody, we're going to have to make sure we build enough dense housing for everyone. So I think that single family home ideal is doing more damage than good at this point.
Yeah, and some cities are now either getting rid of or relaxing the single family zoning, Minneapolis, but consider Boston, where duplexes are very common. Yeah, and the reason why it became very common was that during the Irish famine and sudden arrival of million Irish, they just simply didn't have enough housing. And people said, well, I have a single family home, why don't I make it into a duplex? And that legacy just carries on to today, where they have more housing units by just simply dividing it up to accommodate more people.
And the auxiliary housing, right? So now maybe you can build an in-law unit in your, next to your home or attached to your home. And there are now, a lot of areas are permitting you to rent those out if you no longer need it as the in-law unit, or you never wanted it as the in-law unit. But they're now permitting that because there is such a housing shortage, which I think is a good trend.
Hi, Amber Hare with the Pacific Coast Business Times. I covered housing actually for a while before I moved into an editor's role. One of the things that you mentioned and touched upon is that housing is a generational thing. It's not something that's going to get fixed overnight. And you can't build our way out of this very quickly. Is this a trend that's going to linger for years past the pandemic? Are we looking at this being, will it still be harder for people to, will the pandemic's housing trends continue to impact the ability to pay rent in 5 years, in 10 years?
Yes, I think we're going to be grappling with this housing shortage for at least another decade. The silver lining, though, is that although housing prices are going up everywhere in the country, people are finding a way to adapt. If you're moving from a place like New York to, say, Philadelphia, you're going to probably be in a better situation. You might have more disposable income, and you might be able to keep your high-income job because the labor market's so tight and because of remote work. So I think that we're still going to be grappling with this housing shortage at the national level, but I'm a bit optimistic that individuals are going to be able to find a way to make it work for themselves. The people who are going to suffer the most, though, are the people who can't adapt because they're stuck in place, they need the resources wherever they are, they have family ties, so that's who I really worry about.
And I think another thing we need is some sort of financial education as coursework in school, because I find a lot of people don't know the difference between buy versus rent. They really don't. And that's something that if they're not taught early, they're not going to look at it. They're just going to go rent. And I think that if we have good financial education and say, well, think about it. Maybe buy versus rent sways to buy here or sways to rent here. But you should have some basic knowledge to be able to make those decisions. And I find certainly my education was completely lacking of any of those things, even though I was an accountant by trade. But it's important. People need to know what they should be doing through those lenses.
Hi, I'm Rachel Lane. I'm a freelance journalist. I was with Bloomberg for a long time, covered the housing collapse. One of the trends that has been covered a little bit but not enough is conversion of office space, with many office buildings returning. Are you seeing that as a trend continuing? How do you expect that to shake out? It's not the easiest thing to do, especially with supply chains being clogged and the supplies needed to do it.
So not only offices, but consider shopping malls, so where you have a certain town where you can only support now one shopping mall rather than two. So what happened to the second one? Could it be converted into some residential unit? So all this needs to be considered. Now with the high material costs and rising construction costs, the rehab actually makes better sense because one do not have to purchase new materials, it's already there. But conversion, of course, is costly as well. How do you get the bathroom in an office where it's centralized? Now you have to put it in individual units. So there is cost involved in that. But I think the repurposing certainly is a way to go to transition from some vacant property into habitable residential properties.
Yeah, I have heard that office buildings in denser cities are, in certain cases, getting converted to apartments. Have you noticed?
I think it's difficult. Everyone we spoke to toured their properties. They're 80% vacant, even though they're paying rent, but they're 80% physically vacant. Most of the developers who own these, they can't. It's too long, the way that the corridors work, the way everything works in the structure. It's almost impossible. Also, the real estate tax bill on those buildings is humongous. So to divvy that up amongst individual unit owners, if the city doesn't want to lose that revenue, is complicated. Who's picking that up? Because office buildings have a higher rate. So I don't see that, but I do see the shopping mall. Shopping mall, we are seeing people are looking at shopping malls, golf courses, all kinds of things where one would never think that's going to become apartments, and it is happening.
Hi, John Wu. I was on the previous panel, so if this was covered, apologies because I came late to this. A lot of the stuff we're talking about is secular trends in affordable housing and just general housing. Given the advent of things like Robinhood, which has democratized access to short duration assets like stocks and crypto and whatever, what will be the effect, I guess, what's the delay in terms of the mismatch between housing as well to the short-term, asset classes? Like, when will the demand destruction that's happened so far in the stock market affect housing at all levels and all income classes?
Well, in terms of the wealth building, some excess, people out in Silicon Valley, they're always trying to come up with some creative product, some type of share ownership to say that, okay, as a first-time buyer, you don't have the money to buy, but we will give you a certain amount of money, but we will be part owner. We will be about 60%, 70% owner. We don't get to live in the property, but once you sell the property, whatever the capital gains will be divvied up. So people are trying to come up with some solution on the affordability, but it really has not taken off in terms of, say, a new financial product really making some big gains. They're trying trial and error here and there, not really catching on, or initially caught on, but fizzling out. And regarding just home purchase, since the just major expenditure that is required, even though the market for FSBO, which is for sale by owner, has always existed. People do it on your own if you want to do it on your own. But consumers have said, no, we don't want to do it on our own. So in the marketplace where that is an option, people are saying, no, I want to work with a realtor. And we are finding that 90% of the transactions that are occurring with the realtors, even though the marketplace for do-it-yourself has always existed.
Yeah, but to your point, there are plenty of alternative investments, hedge fund investments you can make. It's not democratized because it's not the average person. You have to show that your net worth is in excess of huge amounts of money, but you certainly can invest in things like Picasa for buying 1/9 of a home. There's all kinds of things coming out. But again, those are the super wealthy and alternative investments, hedge funds, not democratization a la Robinhood.
Yeah, I think that it's, whenever you're coming at it from the demand side, if you're making it easier for people to buy homes, it's not going to solve that fundamental problem that there aren't just enough homes. So I don't think that's the right approach to try to solve affordability, is to make it easier for people to borrow. I mean, that's what happened during the last financial crisis, was we just made it really easy for people to borrow. We have to attack the supply problem to make things more affordable.
Oh, I think I was very excited about our discussion. I think we ran out of time. But thank you so much. This was really fascinating. I don't know if we have time for final thoughts, or do we need to wrap it up?
We can take final thoughts.
Okay.
I'd love to hear final thoughts.
Yeah, I would love to hear any final thoughts you have, or sort of anything you're going to be watching for as we kind of move forward in this very strange period.
The heated market is over. Now we're going to moderate. Let's see how the degree of the moderation.
I'm excited about the YIMBY movement, the Yes in My Backyard movement. I think that people are becoming more aware of these housing issues, and I hope there's more local action, political action, especially among young people, to advocate for more housing being built.
Yeah, I think that's super important. I think if people do not pay attention, advocate, are knowledgeable, financially educated, then we're not going to get movement. So that really needs to be the call to action.
See, people really care about housing. Great conversation. Thank you so much.